Welcome back, everyone, to another episode of Debits and Credits with Haas and Dawe. And today we're going to talk about an update on reporting requirements, and something that is a big bugaboo with I know everyone with handling escrows, trusts, and LLCs, limited liability companies, and because there's so many nuances to how the reporting gets done, and this is something where it's very commonly a 3-hour seminar that we put together. Well, we're not going to do that today. We're going to try and cover this in our normal format. And keep in mind when we talk about LLCs, the C does not stand for corporation. The C stands for company. And a limited liability company is a legal concept. It is not a tax concept. And so that's be careful about when people are telling you that the seller is an LLC or the buyer is an LLC and so on. So we're going to talk about some issues regarding the trust and LLCs when it comes to FERPTA, the Form 593 for California withholding, and the 1099-S reporting to the IRS. Now, also, whenever we talk about trusts, it also really means trust and estates. So the two of them work together. And so keep those in mind. So we're going to talk about trusts and LLCs and the challenges they bring to escrow relative to um, um, the documentation and how to do the reporting and all the different concepts that come up that tend to be a little bit of a pain in the neck. Now, also, um, one of the challenges that you have to deal with is the fact that at the time you're dealing with this escrow, you may not have the whole trust document, or you may not have the whole LLC operating agreement. Now, to a certain extent, they're private documents, and certainly on the trust, you're not entitled to a copy of the trust. Part of the reason why people form trusts is for privacy and not having to go to probate court. Now, there's this document known as trust certification that you can get, because what it's going to tell you is who are the grantors of the trust, meaning who the people who set up the trust and are funding the trust, who the trustees or successor trustees are, and then we call it the powers of the trust, meaning you want to see within the trust that it says the trust has the power to buy real estate or to sell real estate or to refinance real estate. Um, and this document then needs to be signed and notarized so you know that it's valid. And the same thing with an operating agreement of an LLC is something that probably isn't as private as a trust, but you may or may not get it. Now, one thing you do need to know with an LLC is who are the authorized signers, and that's something that you can certainly get from the Secretary of State is who the members are. But it may be that they have other people who are within the LLC who are on the operations team that you need to know whether they're authorized signers for the LLC. Now, normally it would be a managing member that can sign, but that you want to get that information. Um, you want to get that information. Now, where is a concern to escrow relative to the operating agreement and particularly on the trust side, is when it comes time for dispersing. Do you know who all the players are? Particularly on a trust, you don't know who the beneficiaries are, and you don't really specifically know if there's an asset or assets within the trust, what's supposed to be dispersed or distributed, how, and so on. So that makes it a little bit difficult. So you have to be careful of this trust certification you're getting that it gives the information you need. Well, it's also why we tell people never, ever, 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 never, ever, never. We got that? Never disperse to a beneficiary. You always want to disperse to the trust and let it be up to the trustee of the trust to deal with the disbursement out from that standpoint. Because also, you don't know who's paying the tax on the transaction. You don't know where the money goes. You don't know whether it's even. You don't know if there's other conditions within the trust. So that's why you want to always just pay just proceeds to the trust. Now, with regards to the LLC, the limited liability company, the first concern is how many members are there? Meaning if there's more than one member, then that LLC either can be taxed as a partnership or can be taxed as a corporation. But there's more than one person involved. If there's only one person involved, it's known as a single member LLC. Well, then that gets to be a little bit um, tricky in that you need to deal with your single member. Now, it may be on the grant deed that it's going from the LLC to a buyer type of thing. But if it's a single member LLC, the taxability, the tax person, the emphasis is the single member. And if the single member is an individual, then you're dealing with an individual. If the single member is a corporation, then you're dealing with a corporation. If the single member is a trust, then you're dealing with the trust. So you get the gist of it. You're dealing with a single member, and it impacts how the 1099 gets done. It impacts how the 593 gets done. And it may impact FERPTA as well because who the member is. Because, for example, if you've got a 593 and you're dealing with a single member LLC on the 593, which is the California withholding form, the you're not going to be reporting on the LLC if it's a single member. You're going to be reporting on the single member and that person's tax ID number. If the single member is an individual, then you're reporting on the individual and a social security number. If the single member is a trust, now you're going to have to deal with the trust rules, which we're going to talk about. If the single member is a corporation, there's not going to be any reporting at all because the corporation can check box 6 on the 593 in Part 3 saying no withholding applies. So that's why it's important to know what's going on, who your member is. Now, with regards to the 1099-S, it's picking your poison. Meaning if the single member LLC has its own tax ID number, you can report on the single member LLC. If the single member LLC doesn't have a tax payer identification number, you're going to be dealing with the individual and the social security number. Why the tax ID number for an LLC is okay with the IRS on the 1099-S is because the IRS already can cross-reference that tax identification number back to the single member and look for the reporting done by that single member individual. Now, with regards to trusts, there are two things going on. There's a grantor trust, there's a non-grantor trust. The grantor trust means the people who are setting up the trust are still alive, or at least one of them. If it's two spouses, at least one of the two spouses is still alive. A non-grantor trust means the grantors aren't around anymore. And usually it means because they both passed, or they've passed, or he or she have passed. But there are certain times where non-grantor trust, the grantors are still alive, but maybe they're incapacitated, or maybe because they don't want to deal with the day-to-day operations of the trust anymore. And that gets into the question of being revocable or being irrevocable, because most grantor trusts are revocable, meaning the grantor can go and change whatever they want to change. But once the grantors have passed away, the trust becomes irrevocable. It can no longer be changed unless a judge in probate court has decided that it's okay to change. And that's why when you're dealing with grantor trust, you're not only dealing with the individual grantors. It's going to default to the individual grantor. So now you're talking about Form 593, like we had talked about before, in that the on the 593, and you've got a grantor trust in Section 2, where you talk about the seller. There's a little checkbox right on the top of that section, and it says a grantor or non-grantor trust. If it's a grantor trust, you're going to check that box, but then you're not going to show the name of the grantor trust on the 593. It's going to be the individual name and the social security number, because that's where the tax is going to fall. Now, if you've got two spouses, this is where it gets to be a little bit not so much fun, in that you have to put both spouses and both their social security numbers on the 593 instead of just the grantor trust and its number, or just one of the two grantors. Because in California, which is a community property state, if there are spouses and you don't show both spouses and their ID numbers on the 593, any withholding that gets done is only going to get credited to the person whose name shows up, and it'll only be half of the total amount. So it gets to be a little bit dicey from that regard as well. So you have to be careful relative to who you're dealing with on the 593, and what exceptions. If it's a grantor trust, the 593 is as if an individual is completing that form. Now, on the 1099-S reporting for a grantor trust, usually the grantor trust doesn't have its own tax ID number. That was something that was common in the 60s and the 70s, and then the IRS was getting so overwhelmed with people getting tax ID numbers for grantor trusts and filing grantor trust tax returns, they said enough. Go by the social security number of the grantor. You have to be careful. You have to be careful about that. Now, for FERPTA, which is the Foreign Investment in Real Property Tax Act, where you have a foreign seller involved, now we're back to the point of LLCs and trusts. And So escrow, that's all of you, needs to determine at what level the presence of a foreign seller appears. Meaning if the foreign seller is an individual, that's pretty straightforward. But let's say you have a trust. The residency of the trust is determined by the residency of the trustee or of the trustees. So if you've got a grantor person who's from England or a foreign country, yet the trustee of the trust lives in the United States, that's not a foreign trust, and that would be no FERPTA requirement. But if everybody touching the trust is from outside of California, then you have a situation where that's going to be FERPTA requirements. With regards to an LLC, the usual rule of thumb is that the residency of the LLC is determined by the state of organization in a lot of ways. So if the LLC was set up in Wyoming or South Dakota or Alaska, which a lot of people are doing because those are non-income tax states, you still have to deal with um, who's involved. If it's a single member LLC, even though the LLC was set up in this country, if the single member doesn't live in this country, it may be subject to FERPTA. There are other circumstances that would have to be evaluated. And then you have to just be able to drill down and drill down and drill down and drill down till you find somebody who is a responsible party who can make where it can be determined whether FERPTA does or doesn't apply. And definitely in the case of the 593 and the California withholding, or in the case of the 1099, that's going to help with the drill down too as to where these people are located. And so if let's say the trustee or the grantor of a trust is another trust, then you have to go to that trust and find where those trustees are. Or if an LLC, if you've got members of an LLC or more LLCs, you got to keep going until you find out a responsible party who gets blamed, so to speak, for the reporting, for the taxation, for the proceeds, and so on. And so it just needs to be determining who your true seller is, um, and eventually probably get to an individual level or get to a taxpayer level of some sort that will help determine what needs to be done. But the other thing you have to be careful about in determining who is who, so to speak, on this trust and LLC situation is where are you sending the money to? And as much as people who are either are the members of the LLC or are the trustees or beneficiaries of the trust, and they keep saying, "Where's my money? Where's my money? Just don't show me the money," type of thing. You've got to be careful as the escrow person on how you disperse because you want to make sure that the proceeds are going to the right place. If you start paying proceeds to beneficiaries, you don't need to find out 6 months later that another beneficiary shows up who you weren't told about and they want their share and you have no money left. Or you have an LLC and it's a single member LLC and it drills up to another single member LLC and it drills up to an LLC or it drills up to a trust. Again, you don't want to be paying proceeds to people who aren't in the food chain, so to speak, or where the taxability or the taxation is not at this um, beginning level. It could be that the grantor trust pays its own tax, or maybe that the LLC has to report and pay its own tax, depending on total gross receipts or what goes on to the member or members at their level and their individual taxes. So you just don't know it. You don't know that whole tax picture, so you don't want to make any assumptions or presumptions on how to disperse. You wanted to pay the money to the entity and usually it's to the grant deed because on a 1099-S form, the code, Internal Revenue Code specifically says whoever is on the grant deed, that's your seller. And then if you have these other circumstances relating to trust and single member LLCs, then you get some evaluating, but that's where you're going to be driven by. Ooh. So that's enough for this episode of Debits and Credits with Haas and Dawe. We're going to have future episodes dealing with trusts and withholding issues and some other issues as well, and single member LLCs. So too much for this episode. Whet your appetite, and we'll be going forward to another one coming to you soon. For now, goodbye for Debits and Credits with Haas and Dawe.